Hello YouTube, this is Alex, and this video I'm gonna be discussing what to expect in a bear market and how to trade it. I'm thinking that most likely we are entering a bear market because we already had a move of over 20% and we are below the 200 EMA or exponential moving average. So this is a good chart that I found from First Trust, and it's actually talking about different bull and bear markets. And the important thing that I want to mention here is the average duration of the bear markets is around 1 year, 1.3 years, and the average cumulative loss is 38%. So that's one of the things that we can expect, and one of the reasons that passive investors are gonna be the most hurt if something like this is going to happen. They might panic, and the psychological stress is going to be pretty high. So we need to do a plan on what to do to take advantage of this, because it doesn't happen every year. So another thing that I want to mention here is these periods of recessions, and are marked here gray. And as you can see, every time there's a gray and there's a bear market in a recession, you can see here we have a big down move of 83%, 47%, 42%, 21%, 29%, 37%, 44%, and 50%. So those are pretty big move, and as you can see here, there's still a lot of space to move if we were gonna move that much. So let's take a look at this graph to have a little bit more context. So from the top, the lowest we went on the SPX, this is the S&P 500 index, was 27% or so. So if we were going to get to the 50%, we will be pretty low. So it will be around the 1700 level, or maybe close to the lows of the 2016. If we get the lows of 2018, then it will be 31 or so percent. So what to expect in this couple of next weeks? The biggest thing was the velocity of the move. As you can see, is very, very fast. This is telling me that this is kind of a black swan event, so it's not something that happens every day, of course, or every year. And most likely we're gonna get into a recession now that for example, the GDP is gonna most likely go to 0 and then into the negative territory. So earnings for most companies with this situation are gonna get affected, and of course the prices are gonna get affected. But in reality, we don't know when it's gonna be the bottom, or how low, or even if this is the bottom, this is also possible. So I will say there are only 4 scenarios, and I'm gonna put it in the less likely to most likely scenarios. So we need to think in terms of probabilities and then plan accordingly, so that we can have a strategy on how to trade it. So the less likely scenario, I will say, it will be a V shape here, for example. This is the less likely scenario, that this is the bottom and we get like a very impulsive move to the upside. It's not very likely that we will get this sharp move. Okay, so the second scenario that I think is also not that much likely, it will be that from here we continue to drop down like a bomb, and continue directly down, like this same move once again we can expect. So the most likely thing that we can expect is that we're gonna bounce a little bit and keep the volatility very high, and then either go up and continue to go up, or continue to go down. So something like this. In the example, we got a move down, then a kind of a correction, and then a continued move down. So this to me will be the most likely scenario, and the other scenario will be something like this. It goes down, two-sided, and then continue to go up. So to me, if this is the most likely scenario that I think is going to happen, we have to plan accordingly, right? So the first thing is that we know is that there's gonna be a lot of volatility. If we go back, I have here mark another bear market. This is in 2008, and as you can see, we got that first move down when we broke the 200 exponential moving average, and we went back, then continue down again, kind of a bounce back and up, and then retest the moving average and continue to go down. So if we go individually in some of these candles, each candle represent 1 day, we can see that there are a lot of pretty big candles. For example, let's take a look at this one. So for example, this one was like 9% down and 10% up. So again, 10% up. This one was like 5% down. This other candle was again like 4.6 up. This one like 8% down. So as you can see, there are gonna be a lot of big candle and big movements in every day. So in terms of if you're planning to day trade, it's gonna be really hard because your stops are gonna get triggered. So it's not something that I will recommend. So if we go even farther, and this is the 2000 bubble, again the same thing or similar. We broke the moving average and then went back up again and tried to retest it, and then continue to go down, kind of a two-sided action. So it's not likely that we're gonna go directly downward, but we're gonna have a kind of a sloping movement until we can again recoup break above the 200 moving average. So if we go back again to where we are now, what can we expect and what can we trade? If we think in terms of probability, most likely we're going to get a retracement a little bit up, maybe to these levels or these levels, to kind of retesting the moving average. I will say around the 3000 level, and then kind of either bounce or and try to retest the lows, or just take it and continue to go down. That will be the most likely scenario. So what I will do is, if we go to, will be the expected move for this week. In the next 5 days, we have almost a 200 point expected move. And if we go to the upside, the 1 standard deviation is basically around 2950 level. So the 2950 level is around here or so. So most likely I will say it will go something like something like this, right? So how do we trade it? The first thing that we need to understand is that buying this stock is not ideal, because of your stop losses are gonna hurt you quite a lot. And so we need to use options. And with the volatility high, let's show the VIX. Here, this is the VIX, and we are at very high levels. So the premium, we're gonna get a lot of premium. This is the highest it has been since quite a lot of time, since 2008, basically 2009. And if we take a look at this at this level in the bear market that we mentioned before, it stayed pretty high for quite a lot. So from the highest day, or around, let's say, around this period, around 41 days, and still pretty high. So the first volatility crash was around every 3 days. So it can continue to go for a very extended time. Let's see another example here. This one was not as elevated, but again, around 66 days and continue to be really elevated. Here, so we're just at the beginning of this move, so we may have like 60 days more with high volatility, which is good for selling premium. But the thing to understand is that if you're gonna be selling premium right now, I will suggest doing with defined risk. Why? Because the one of the advantages of the defined risk over undefined, first is the return of capital. You get more bang for your buck, better buying power use. You know your max loss from the beginning, and one of the benefits from going naked, or going just like setting a naked put or a naked call, is that you get that volatility crush, which helps you quite a lot. If you define your risk, you're not playing that much in terms of the volatility crush. You're playing more in terms of time decay and the expected moves. So you can play that part. So if you go and try to plan for this week, what will be the plan for this week? If you want to make a trade right away, the first thing that you can watch is the expected move. What is the expected move? And try to stay away from it, or wait to see if there's a pullback, let's say to this level, and then short it. So that would be a pretty safe bet. Let's say if it goes back to these levels, and let's we mark here kind of a Fibonacci levels. In terms of a pullback, we may get, if we get a small pullback, let's say to the 3820, which will be close to these lows over here. So that would be 5%. So this can happen just in one day. Let's say if we went to go to this 61.8, this would be a 12% move, and around the 3000 level will be around a 10% move. So in a week, if we get this 10% move, at this moment you can get short, and the way I will get short will be doing a synthetic short, and I'm gonna show you in the next video how one trade that I did and how to manage it, and why I think is the best trade to do in this environment. Because if you do just let's say a short call spread, which is gonna be at this level very high probability, or if you already have longs, then you can reduce your risk by either closing your positions and then entering short, or hedge your position so that you don't get too much exposure, or reduce your size if you're still thinking it's gonna go up. So hopefully this is something that was useful. If you have any questions, just ask, and I'll be trying my best to help you out. Thank you. Bye.